Assalamu alaikum. Very good day to you. And first, I would like to provide all types of praise for the Almighty Allah who has given me a chance to join such like a digital platform. And today, I'm going to take a session on financial management. And I hope so. This session will be very much interesting and enjoyable to you. And before it, I would like to introduce myself at first. And here, I am Muhammad Mohammed Hussain, lecturer, Department of Accounting, Government of Saudi College, Magura, and I am responsible for doing the respective assigned tasks given our honorable principals, Government of Saudi College, Magura, and the head Department of Accounting, Government of Saudi College, Magura, respectively. So, dear participants, I hope so. It will be very much interesting and enjoyable to you, and these slides also make it very easy for you to understand. I hope so, for better understanding. So now, before launching my presentation, I would like to make a quotation to you in front so that the main purpose will be understand very clearly. The main purpose of university teaching or teaching, the main purpose of teaching is not to give an explanation, but to knock at the door of the mind of the participant so that he or she may explore himself or herself and may set himself or herself as a real man of tomorrow. So it is strongly required to know what is the main purpose. That means main purpose is not to explanation, but to knock at the door of the mind of you so that you may understand in what way you have to set yourself and may set yourself as a real man of tomorrow. So dear learners and dear friends, let's go to the slide directly. What is the today's topics? And today's topic is capital budgeting and investment decisions. Capital budgeting and investment decisions. So capital budgeting is strongly required for taking the decisions. Otherwise, it will not provide the exact figure, and if you do not do, it will provide wrong figure of revenue rather than actual. And for this reason of being loss, cost and benefit should be measured at first, and for this reason of being capital budgeting, you have to set. So capital budgeting means planning for capital assets. Actually, capital budgeting means planning for capital assets, and planning for capital assets based on the three particular items. Number one, the payback period. You have to calculate the payback period. Number two, net present value, and number three, internal rate of return. Okay, so it is time to know the overview at a glance so that we may understand what we are going to do. Number one, we will know about the definition of the budgets, and number two, budget sectors and types of the budgets, and number three, capital budgeting, number four, importance of the capital budgeting, and number five, capital budgeting and project categorization, number six, capital budgeting and its 8 steps, and number seven, we will understand about the evaluation criteria and capital investment appraisal, and at the end of the session we will draw a conclusion on it. So we have to calculate about 3 maths on the particular items, 5 maths, 5 items on these particular items, and we will draw a conclusion in a nutshell. And I hope so, when the question paper will be given to you at the examination, you can able to solve very clearly and consciously. So I must not want to waste my time, so go to the definition of budget. You know very well, budget means statistical representation of plan, and plan means thinking before doing. What we will do in future that would be prescribed at present time is called plan. So what will be the budget? Budgeting is a management tool for planning and controlling future activities. Budgeting is a management tools for planning and controlling activities. So in a short we may say like that, a plan for savings, borrowings and spendings. That means budget means 3 particular combination of items. Number one, savings, number two, borrowings, and number three, spendings. So budget is a financial plan, a list of all planned expenses and revenues. So now it is time to know the budget sectors, so on which the budgets are calculated. Number 1, business startup budget, corporate business budget, corporate or business budget, government budget, event management budget, personal or family budget. These are the particular sectors on which we have to set the budget. What are the particular types? Budget types are based on flexibility, variable and fixed budgets, fixed and variable budgets. On the basis of the time periods, short-term and long-term budgets. On the basis of the functionality, there are particular items of budget. Number 1, sales budget, production budget, marketing budgets, project budgets, revenue budgets, cash flow or cash budgets, etc. So, it is time to know the capital budget. So, capital means operating assets used for production, and budget is a statistical representation of plan. Am I right? So, capital budgeting is a process of analyzing project and deciding which one to include in the capital budget. And capital budgeting is the process of analyzing the projects and deciding which one to include in the capital budget. That means it is the analyzing process. Should we build this plant or not? Should we do it or not? And with it, the financial and statistical presentation will be adjusted. So, the question may raise in your mind, what is the particular importance of capital budget? There are particular sectors we have to consider while preparing capital budget. Number 1, growth. Number 2, large amount, irreversibility, and number 4, complexity. Number 5, risks, and number 6, long-term implications. These particular items should be considered while formulation capital budget, while calculating capital budget. There are particular benefits. These are: number 1, capital budgeting decisions evaluate a proposed project to forecast returns from the project. Capital budgeting decisions evaluate a proposed project to forecast the returns from the project. And number 2, to determine whether returns from the project is adequate or not. Do you understand very clearly, I hope so? To determine whether the returns from the project is adequate or not. Is enough or not. So, the question now when come to you, capital budgeting, project categorization. What are the particular categorization of capital budgeting? Number 1, there are particular 6 items I have set here for better understanding. Number 1, the establishment of new products and services. Number 2, replacement projects, maintenance or the cost reduction. Replacement projects for maintenance or cost reduction. And number 3, explanation of existing projects. And number 4, research and development projects. And number 5, long-term contracts. Number 6, safety or environmental projects. On the basis of on the basis of capital budgeting, these particular 6 items usually considered in such a way so that the project may come to. So, in a nutshell, we may say as like that capital budgeting is the planning process used to determine a firm's long-term investment such as new machineries, replacement machinery, new plants, new products, and research and development projects. So, it is time to know the 8 steps of capital budgeting. For formulating capital budgeting, we have to follow the 8 steps. Number 1, have a good idea or realize the need for the project. Number 2, look for the suitable projects. Number 3, identify and consider the alternatives. And number 4, carry out a financial analysis, capital investment appraisal. And number 5, analyze the alternatives and identify the feasible alternatives. And number 6, choosing the project to undertake. Choosing the project to undertake. And number 7, monitor the project along with the rest of the organization. Number 8, carry out the post-completion audit. So these are the 8 particular steps you have to follow while making capital budget. So it is time to determine the particular items which we have to calculate as a practical solution for a given problem. Number one, payback period. We have to calculate payback period, ARR, average rate of returns, discounted payback period, net present value, profitability index, internal rate of return. That means payback period, ARR, discounted payback period, NPV, net present value, profitability index, and internal rate of return. Okay, now it is time to know for question. When the question will get given to you, then in what way you have to give the answer. Evaluation criteria. On the basis of the evaluation criteria, there are two types. Number one, on the basis of the non-discounted criteria, and on the basis of the discounting criteria. On the basis of the non-discounting criteria, payback period and average rate of return. On the basis of the discounting criteria, discounted payback period, you have to calculate net present value. Even after that, you have to calculate profitability index and internal rate of return. Okay. Now, non-discounting payback period, we have to get an idea about it. The number of years required to recover the initial or original cost of invested in the project. That means the number of years in which the initial investment may be recovered or may be covered. This situation is called payback period. It has two conditions: when the cash inflow is constant every year, and when the cash inflow are not constant in every year. So the payback period's formula will be completed years plus required inflow into 12 divided by inflow of the next year. Okay. Now, in case of non-discounted criteria, annual rate of return, the average rate of return, internal average rate of return means the average annual earnings on the project. Under this method, profit after tax and depreciation is considered, and the average rate of return can be calculated in the following two formulas. Number one, average rate of return on average investment, average profit of tax into 100 divided by average investment. In case of average rate of return on initial investment will be average profits after tax into 100 divided by initial investment. So these are the formulas for calculating average rate of return. Now the question may raise in your mind, what will be the discounting criteria for payback period? For payback period, discounted payback period methods. In discount payback period methods, the cash inflows are discounted by applying the present value factor for different time period. And for this reason being, the discounted cash inflows are calculated by multiplying the present value factors into the cash inflows. Actually, this theory will be very clear if I give the practical example and practical problem solution. So, what will be the formula in this particular cases? The discounted payback periods will be completed years plus required inflow into 12 divided by inflow of the next year. Now we have to know about the net present value methods. It is the best methods for evaluation of the investment proposal. This method takes into account the time value of money. As it takes into the time value of money, this is why it is the best methods for evaluation of investment. Evaluation of net present value methods project with the higher NPV should be accepted. When the higher present value will come up to you for a project, then it will be accepted. Otherwise not. That means if net present value is greater than 0, then it will be accepted. If it is lower than 0, then it will be rejected. And if a net present value equal to 0, you may accept the project or not. Okay, so this is the characteristics of net present value for evaluation. So it is time to know about the idea of discounting criteria for profitability index. Profitability index, as the Net present value method is also shows the project is accepted or not. If the profitability index is higher than 1, the proposal can be accepted. If it is lower than 1, then it will be rejected. So accepted means profitability index will be higher than 1, and when it will be rejected, when the profitability index will be lower than 1. So what will be the formula? In case of profitability index, the formula will be total cash inflows divided by total cash outflows. So dear friends, look at this session. Discounting criteria in case of internal rate of return. And after this slide, we will go to the practical problem solution. So internal rate of return methods. Internal rate of return is the rate of return that a project earns. The rate of discount calculated by error and trial basis. It is based on error and trial basis. That means you have to try, and you have to make sure one figure present value will be positive and another will be negative by considering the present value factors. The total net present, one will be positive and one will be negative. Okay. Internal rate of return. There are two ways we have to consider. Number one, in case of higher rate, in case of lower rate. Internal rate of return by considering the higher rate minus net present value of higher rate into difference in rate divided by difference in cash flows. In case of considering lower rate, internal rate of return will be lower rate plus net present value of lower rate into difference in rate and divided by difference in cash flows. So it is time to set an example, practical example, and understand very clearly. Even after that, we will calculate on it. This question will be given to your question paper and you have to solve. Okay, here the expected cash flows of a project are shown by this chart. 1, 2, 3, 4 and 5 years are given, and for this, for 1 year 20,000, for second year 30,000, for third year 40,000, and for fourth year 50,000, and for fifth year 30,000 taka as cash inflows are expected. And additional information are given to you. The cash outflows is taka 1 lakh. Cash outflows means this amount will be invested. That means outflows. This amount will given out from your company or from your respective capital. How much amount? 1 lakh. It is also said as like NCO, net cash outlay. Net cash outlay. That means initial investment. That means cash outflow or initial investment or NCO is the same space. Okay. So how much amount? 1 lakh. The cost of capital. The amount of cost we have to pay for using the capital. How much amount? How much percentage? 10%. And your requirement for calculation. Number 1, net present value. You have to calculate net present value. Number 2, profitability index. And number 3, internal rate of return. Number 4, payback period. And number 5, you have to calculate discounted payback period. Okay, this is the question paper to you and you have to solve by using the formula. So before it, present value factors at 10%. In what way we have to calculate? We have to calculate 1 divided 1.10 to the power 1. 0.10 means 10%. Okay, 1 divided 1 plus 0.10 to the power 1. So for first year, how much amount will be the factors? Present value factors at 10%, 0.909. Similarly, in second year, we will get 1 divided 1.10 to the power 2, we will get 0.826. In third year, we will get 0.751. In fourth year, we will get 0.683. In fifth year, 1 divided 1.1 to the power 5, we will get present value factors at 10%. In the fifth year, 0.620. So this is the present value factors at 10%. Now, computation of the net present value and profitability index. 1, that means it is very clear to you. Okay, that means 1, 2, 3, 4 and 5th year, and for this reason of being the cash flows are given to you 20, 30, 40, 50 and 30,000, and present value factors at 10% is have already calculated. In for first year 9.909, second year 8.826, in third year 751, and in fifth year 0.62. So in what way we have to calculate? That means present value of cash flows will be 20,000 into 0.909. Then we'll get how much amount? 18,180. Similarly, in second year we'll get 24,780. In third year we'll get 30,040. In fourth year 34,150, and in fifth year 18,600. So in total, that means the NCO, total present value, that means total cash inflow is 1,25,750. So what was the initial investment or cash outflow or the NCO? NCO, how much amount was there? 1 lakh. Am I right? So less cash outflow means NCO. Okay. So what will be the net present value? Net present value means TPV, total present value, divided NCO. We will get 25,750 net present value. Total present value, from total present value we have to deduct net cash outflow, then we will get net present value. So in what way we have to calculate profitability index? Total present value divided NCO, we will get 1.2575. Profitability index will be shown 1.2575. I hope so. This is very clear crystal to you. Dear learners, it is time for us to calculate the internal rate of return, and we have already said earlier it is the error and trial basis. So for this reason of being, we have to set randomly the rate for getting the expected result, because one result of net present value will be negative and another will be positive. If the net present value negative and another is positive, may not, then you can't. It is never and never be possible for you to calculate the internal rate of return. So for this reason of being, it is your duty to check out and to set the rate on the basis of error and trial. So here the practical example, present value factor at 10%, not, it will be 18%. Actually here a clerical mistake. So in 18%, what will be the in first year? I have already said earlier, it will be 18%. So 1 divided 1.1 plus 0.18 to the power 1. So in first year will be 0.847. In second year it will be 0.718. In third year it will be 0.609. In fifth year 5.16. And in fifth year it will be 4.437. In fourth year 0.516. Okay, so by considering the present value factor at 19%, what will be the figure? In first year it will be 1 divided 1.1 plus 0.19 to the power 1 equal to 0.840. In second year 0.706. In third year 0.593. In fourth year 0.99. In fifth year it will be 0.420. Am I clear? So present value factors at 19% and present value factors at 18% we have already calculated. So it is time to calculate the IRR. In first year the amount has given to you. At 19% we have already calculated from the 0.840, and second year 0.706, in third year 593, and fourth year 499, and in fifth year 0.420. Okay, so in what way you have to calculate? We have already said 20,000 into 0.804 will get 16,800. Similarly, in second year we'll get 21,180. In third year we'll get 23,720. In fourth year 24,950, and in fifth year 12,600. So in total, the total cash inflow, that means total present value, will be 99,250. 99,200, 99,250. So what is the NCO? That means cash outflow. Cash outflow, that means initial investment or net cash outflow, was 1 lakh. Am I right? So what is the net present value? Net present value is minus 750. 750. One is minus, so another will be positive. Otherwise, we can't calculate internal rate of return. So in this particular cases, by using the 19%, what will be the 90% is have already calculated, have 0.847, 0.718, and 0.609 and 0.516, and in fifth year 0.437. So if we multiply 20,000, if we multiply 0.847 with 20,000, then we'll get 16,940. In second year we will get 21,540. In third year we will get 24,360, and in fourth year 25,800, and in fifth year 13,110. So in total, the total cash inflow, total present value, by considering the 18% rate, is 1,01,750. Now you will deduct net cash outlay. How much amount? 1 lakh. Then you will get the plus figure 1,750. So 1 net present value, by considering a 19% is negative 750, and positive by using 18% is 1,750. So as one is negative, one is positive, so it is possible for you to calculate the internal rate of return. Internal rate of return. Now the difference in total present value, 1,01,750 minus 99,250 equal to 2,500, 2,500 taka. Okay, so computation of internal rate of return. Internal rate of return, if we use higher rate, then higher rate minus not present value of higher rate into difference in rate divided by difference in cash flows. So a difference in cash flow. Here difference in rate 19,000, 19 minus 18 equal to 1. So internal rate of return equal to 19 minus 750 into 1 divided 2,500 equal to 18.7%. So it is very clear to you, dear participants. I hope so. Now it is time to computation of the non-discounted payback periods. In what way you have to calculate? Just you have to use the formula. Okay, so before it, in the particular given items are given to you, question paper 1 to 5th year, 20, 30, 40, and 50, and 30,000 taka. So cumulative cash flows, cumulative cash flows here, 20 minus 30 equal to 50, 50 plus 40 equal to 90, 90 plus 40 equal to 140, and 30 plus 150 equal to 170. So in 19,000, there are initial investment of cash inflow. Initial investment will exist in third year, because 90,000 has been exist in third year, and in fourth year initial investment has crossed. So initial investment is existing in third year. So what will be the cash cumulative cash flow of the payback period is 90,000. Cumulative cash flow is 90,000, because initial investment of the project is existing in 19,000 area. That means in third year. It will be not in fourth year, because it has crossed. It has also crossed, because here 1,40,000 and initial investment was there only 1 lakh. So third year is the payback year. So what will be the next year? Next year cash inflow is 50,000. Am I right? So it is time to calculate payback period. Completed years plus required inflow into 100 divided by inflow of the next year. The third year plus net cash outlay minus 90,000 payback years cumulative cash flow divided by into 12 divided by 50. So the result is 5.4 years. So within 5.4 years, the initial investment will come up. So it is time to compute the discounted payback periods. Here also, particular years and cash flows are given. So at present value factors at 10%. The particular factors are given to you. Now it is time to calculate. Similarly again, and here cumulative cash flows are given to you. So cumulative cash flow for first year 18,180, in second year 42,960, in third year 70,000 taka, and in fourth year 1,07,150, and in fifth year 1,025, 1,25,750. So it is mentionable that in third year the initial investment that means 1 lakh has existed in this here, because in fourth year 1,07,700, so it has crossed 1 lakh. So what will be the payback year? Payback year will be third year. So what will be the amount? Amount will be 73,000. What will be the next amount? 34,150. Am I right? So look here, completed years here 3 years, and required the inflow means 1 lakh minus 73,000 into 12 divided by 34,150. So what will be the result? Result is 12.48 years. That means the initial investment of cash will be covered by using discounted payback periods 12.48 years. So dear friends, it is time to calculate. It is time to know the whole configuration at the same time in a nutshell, so that we may understand very clearly what is the exact results of it. Generally, an impression created that the firm should be used net present value methods for decision making, because decision means to choose one best alternatives from a set of alternatives. And most of the large companies consider all the measures because each one provides somewhat different pieces of relevant information to the decision makers. Then it will be easy for you to take the decisions. Here it is my YouTube channel. The friends who are not able to take these sessions very clearly, then you will understand very clearly by using or by subscribe this channel. So I hope so. It will be very beneficial for you to understand all things at the same time. And here I must not prolong my speech, and I would like to give you a special thanks because you have already taken a patient. You have already taken a patient, and thank you all for staying with Mofo.